There is a single, fundamental question that separates the amateur from the master, the gambler from the investor, the person who builds fleeting riches from the one who builds permanent, generational wealth. It's not how much can I make. It's a far quieter, far more profound question, one that echoes in the mind of the most successful investor in history, a man who has compounded capital at a rate that defies financial gravity for over half a century. That question is, how can I lose? This inversion, this obsessive focus on the downside before even glancing at the upside, is not just a clever turn of phrase. It is the central gear in the engine of Warren Buffett's fortune. It is the architectural blueprint for a truly crash-proof portfolio. Most of the financial world is a screaming carnival, a cacophony of voices shouting about the next 10-bagger, the disruptive technology that will change the world, the stock that's going to the moon. They sell excitement, they sell hope, they sell the intoxicating dream of upside. And in doing so, they lead millions of well-meaning people down a path of ruinous speculation, where the thrill of the potential gain completely blinds them to the catastrophic risk of permanent capital loss. This is the costly market mistake that Buffett's entire philosophy is designed to prevent. It's the siren song of a rising market, the giddy euphoria that convinces you that risk has vanished, that this time is different. But it is never different. The laws of financial physics are immutable. Gravity always wins. And if your portfolio is built only for levitation, the eventual return to Earth will be devastating. What we are about to embark on is not a lesson in stock picking. It is an exercise in mental re-engineering. We are going to dismantle the flawed, upside-obsessed thinking that governs 99% of market participants and replace it with a robust, defensive framework. This is the margin of safety mindset. It is a promise you make to yourself, a promise that the preservation of your capital is the highest possible priority. By internalizing this one principle, you will undergo a financial transformation. You will no longer be a passenger on the market's roller coaster, white-knuckled and praying for the best. You will become the engineer, building a financial vehicle designed to withstand the most violent shocks, a portfolio that doesn't just survive the worst-case scenarios but is structured to capitalize on them. This is the key to sleeping well at night, to achieving true financial freedom, not by chasing fleeting gains, but by methodically eliminating the possibility of catastrophic failure. This is the final promise of rational investing. Protect the principal, and the upside will take care of itself. We will deconstruct this powerful strategy into 5 core pillars, each a load-bearing wall in the fortress of wealth that Buffett has built. Each one is a lesson forged in the crucible of market history, a principle that, once mastered, will forever change the way you approach not just investing, but every significant decision in your life. Our journey begins with the most direct and powerful application of this philosophy, the very bedrock of the margin of safety, valuation. The idea is so simple it sounds almost insulting. Buy something for less than it is worth. Yet, in the entire universe of finance, there is no concept more frequently ignored. To truly understand its power, we must travel back to a moment of crisis, a time when a beloved American institution was brought to its knees by a scandal so bizarre it involved non-existent vats of salad oil. This is the story of American Express and the Tino DeAngelis affair, a foundational anecdote that reveals how a deep understanding of value can turn widespread panic into a generational buying opportunity. The year was 1963. American Express was the epitome of a blue-chip stock, a symbol of American financial prestige and reliability. Its travelers' checks were as good as gold anywhere in the world. Its credit card was a status symbol. The company was a cornerstone of conservative portfolio management, the kind of stock you bought and held for your grandchildren. Its subsidiary, American Express Warehousing, was a small, almost forgotten part of the business that issued receipts to companies against their inventory, which could then be used as collateral for loans. One of its biggest clients was the Allied Crude Vegetable Oil Refining Corporation, run by a charismatic but shadowy figure named Anthony Tino DeAngelis. DeAngelis was a master fraudster. He claimed to have massive warehouses in Bayonne, New Jersey, filled to the brim with valuable soybean and cottonseed oil. Banks, trusting the receipts guaranteed by American Express, lent him hundreds of millions of dollars. The problem was, the oil didn't exist. DeAngelis had created a brilliant illusion. His tanks were mostly filled with water, with only a thin layer of oil floating on top for inspectors to see. He moved the same small amount of oil from tank to tank ahead of audits. When a major customer, a German company, went bankrupt, the whole house of cards collapsed. It was discovered that against $175 million in loans secured by American Express receipts, there was only about $6 million worth of actual oil. The scandal, which became known as the Salad Oil Scandal, was a bombshell. Wall Street panicked. How could American Express, the bastion of trust, be so thoroughly duped? The narrative shifted overnight. The company was no longer a safe haven. It was a reckless, mismanaged institution facing potentially unlimited liability. Analysts predicted bankruptcy. The stock, which had been trading at over $60 per share, cratered. It plunged by nearly 50%, dropping to as low as $35. The herd was in full flight. Fear was the only emotion in the market. This is where Warren Buffett enters the story. At the time, he was a young, relatively unknown fund manager running his small Buffett partnership. While everyone else was selling in a panic, Buffett did the opposite. He went to work. He didn't listen to the news. He didn't read the analyst reports screaming, "Sell." He asked a simple question: what is the actual quantifiable damage to the business, and what is the underlying enduring value of the remaining healthy parts of the company? He started his investigation not on Wall Street, but on the streets of Omaha. He went to local restaurants and banks. He talked to merchants who accepted the American Express card and tellers who sold the traveler's checks. He observed customers. He was trying to determine if the scandal had damaged the core brand, the invisible but priceless asset of consumer trust. What he found was that nobody cared about the salad oil. Diners were still using their Amex cards. Travelers were still buying the traveler's checks. The franchise, the fundamental business of facilitating payments and travel, was completely intact. The brand's power, its moat, was unharmed. Next, he dug into the financials. He calculated the absolute worst-case scenario for the liabilities from the salad oil fraud. Even using the most pessimistic assumptions, he figured the total hit to the company would be a fraction of what the market was implying. He then calculated the intrinsic value of the core credit card and traveler's check businesses. He realized that the earnings power of these two divisions alone was worth far more than the entire company's stock price. The market, in its panic, was pricing American Express as if it were going out of business. But Buffett's analysis showed that even after paying for all the fraud-related damages, you were getting the crown jewel businesses for free. He determined the intrinsic value of American Express was at least $65 per share, and here it was, trading at $35. This was the margin of safety. It wasn't a guess. It was a calculated buffer between the price he was paying and the value he was getting. He famously invested 40% of his partnership's assets, a massive, concentrated bet, into American Express stock. Over the next few years, as the company settled the lawsuits and the market's fear subsided, the stock price soared, eventually tripling. This single investment was a cornerstone of his early success, a testament to the power of focusing on value when everyone else is focused on fear. It demonstrates the first pillar in its purest form. By rigorously calculating a conservative estimate of a business's intrinsic worth and only buying at a significant discount to that worth, you build a fortress against both market hysteria and the unforeseen problems that inevitably arise in business. The price you pay is your first and most important line of defense. This anecdote isn't just a story about a great stock pick. It's a clinical demonstration of overriding a powerful and destructive set of psychological biases that cripple the average investor. The underlying psychological principle at play here is a potent cocktail of the availability heuristic and catastrophic thinking, fueled by herd behavior. When the salad oil scandal broke, the story was dramatic, easily understandable, and emotionally charged. This is exactly the kind of information our brains are wired to overweigh. The availability heuristic is a mental shortcut that relies on immediate examples that come to a given person's mind when evaluating a specific topic, concept, method, or decision. Because the news of the fraud was everywhere, it was available. Investors treated it as the most important piece of information about American Express. The long, boring, decades-long history of trust and profitability was instantly forgotten, replaced by the vivid, terrifying image of empty oil tanks and massive lawsuits. The brain doesn't calmly assess probabilities. It latches on to the most recent and frightening story. This leads directly to catastrophic thinking. Investors weren't just thinking the company would have a bad quarter. They were extrapolating the single negative event into total annihilation. They created a narrative of bankruptcy and ruin, where the potential liabilities were seen as infinite. This is a survival mechanism gone haywire. In the ancestral environment, seeing a lion and assuming the worst was a good strategy. In financial markets, assuming the worst based on a single, albeit serious, piece of news is a recipe for disaster. It causes you to sell perfectly good assets at bargain basement prices. Compounding this cognitive error is the immense pressure of herd behavior, also known as social proof. When everyone around you is panicking, your brain screams at you to do the same. It feels physically safer to be in the middle of the herd, even if the herd is running off a cliff. Selling American Express in 1963 felt like the smart, safe thing to do because everyone else was doing it. Holding on, let alone buying more, felt reckless and isolating. This is why a market crash feels so emotionally overwhelming. It's not just your portfolio declining. It's the feeling of being wrong while the entire world seems to be right. Buffett's genius was his ability to immunize himself from this psychological contagion. He did this by consciously disengaging from the narrative and engaging with the numbers. The narrative was emotional, speculative, and focused on the unknown. The numbers were concrete, based on the historical earnings power of the business. By focusing on calculating a conservative intrinsic value, he created an analytical anchor in a sea of emotional chaos. This anchor, the $65 valuation, prevented his mind from being dragged away by the tide of fear. The margin of safety, therefore, is as much a psychological tool as it is a financial one. It's a circuit breaker for fear. When a stock you own drops, the question is no longer an emotional, "Oh my God, I'm losing money, should I sell?" but a rational, "Is the price now further below my calculated intrinsic value? And has the long-term earnings power of the business been permanently impaired?" This reframing shifts you from a state of panic to a state of analysis. It allows you to see what Buffett saw, that the market's fear was a gift, an opportunity to buy a wonderful business at a ludicrously cheap price. The psychological fortitude required for this kind of defensive investing cannot be overstated. It requires a deep-seated belief in your own analysis over the screaming consensus of the crowd. It is a cultivated skill, a deliberate practice of intellectual independence that is essential for long-term wealth management and achieving true financial security. So how do we translate this powerful principle into a practical, repeatable process? How does a retail investor, without Buffett's vast resources, apply this mental model? This is the blueprint for building valuation into your investment strategy. It's a step-by-step guide to creating your own margin of safety, a core component of effective portfolio management. The goal is not to find the exact, perfect intrinsic value of a company down to the penny. That's impossible. The goal is to arrive at a conservative range of value that provides a clear benchmark for your buying decisions. Step 1 is the qualitative analysis, what Buffett did when he walked around Omaha. Before you even look at a single financial statement, you must understand the business. Ask yourself simple questions. How does this company make money? What product or service does it sell? Who are its customers? Is this a business that you can explain to a 10-year-old in a few sentences? If the answer is no, you should stop immediately. This is the first filter. A business you don't understand is a business where you cannot possibly estimate future earnings, making a valuation exercise a complete fantasy. This is a critical risk management step. Assuming the business is understandable, you then move to assessing its durability. Does this company have a long-term competitive advantage, a moat? Will people still be using this product in 10 or 20 years? Is it susceptible to being wiped out by a change in technology or consumer tastes? You're looking for businesses with enduring qualities. Think about things like strong brands, network effects, or high switching costs. This initial qualitative check prevents you from wasting time trying to value businesses that are inherently unstable or unpredictable. Step 2 is where we move to the numbers, but we start simply. Open the company's most recent annual report, the 10K. Don't be intimidated. You're looking for just a few key things to start. Look at the income statement and find the revenue and net income figures for the last 10 years. Are they consistently growing? Are they erratic? Or are they declining? A history of stable, predictable growth is a massive green flag. It makes forecasting the future much easier. Next, look at the balance sheet. You want to see more assets than liabilities. Specifically, look at the total debt. Is it manageable relative to the company's earnings? A company drowning in debt is fragile. A small hiccup in its business can become a catastrophic crisis. This is a foundational element of capital preservation. A heavily indebted company has a negative margin of safety built right into its financial structure. Step 3 is the core of the valuation, estimating future earnings. This is where most people get scared, but we can simplify it. Look at the company's earnings per share, EPS, over the last decade. Let's say a company has grown its EPS from $2 to $5 over that period. You can calculate the average annual growth rate. Perhaps it's around 8% per year. Now you have to make a conservative forecast. If the company grew at 8% in the past, it's probably not prudent to assume it will grow at 15% in the future. A conservative estimate might be to assume it will grow at 5% or 6% for the next 10 years. You are deliberately understating the potential to build in a buffer. Once you have a growth rate, you can project the EPS 10 years into the future. If the EPS today is $5 and you project 6% growth, next year it will be $5.30, and so on for 10 years. In year 10, you will have a future EPS figure. Step 4 is to estimate a future price. In 10 years, what will investors be willing to pay for those earnings? This is called the price-to-earnings, or PE ratio. Look at the company's historical PE ratio over the last decade. Also look at the average PE for the market, which is historically around 15. A conservative estimate for a stable, growing company might be a future PE of 15. So you take your projected EPS in year 10 and multiply it by 15. This gives you an estimated future stock price in 10 years. Step 5 is to discount that future price back to today. $1 in 10 years is not worth $1 today. You need to account for the time value of money and the return you require on your investment. A standard discount rate for a retail investor might be 10% or 12%. This is your desired annual return. Using a financial calculator or an online tool, you can discount your estimated future stock price back to today's value at your chosen discount rate. The result is your estimated intrinsic value per share today. Let's say your calculation suggests the intrinsic value is $100 per share. The final and most crucial step is to apply the margin of safety. You don't buy the stock at $100. You wait until you can buy it at a significant discount. A 30% to 50% margin of safety is standard. This means you would only consider buying this stock if the price fell to between $50 and $70. This gap, this buffer, is what protects you. If your growth estimates were too optimistic, if the company hits a rough patch, if the market goes into a downturn, your margin of safety provides the cushion. This systematic process transforms investing from a speculative gamble into a disciplined business practice. It forces you to adopt a CEO mindset, analyzing a stock not as a blinking ticker symbol, but as a piece of a business you are considering purchasing. It is the practical application of defensive investing, ensuring that the price you pay is your ultimate shield against the unavoidable uncertainties of the future. To truly appreciate the wisdom of this valuation-first approach, we must dedicate time to exploring its opposite, the path that the overwhelming majority of market participants follow. This is the antithesis, the path of the 99%. It is a road paved with exciting stories, thrilling narratives, and ultimately, for most, the permanent loss of capital. The 99% do not begin with a question of value. They begin with a question of price momentum and narrative. They are drawn to what is popular, what is rising, and what has a compelling story about changing the world. Think of the dot-com bubble in the late 1990s. Companies with no revenue, no profits, and no viable business model were being valued at billions of dollars. Why? Because they had a story. They were going to revolutionize commerce, advertising, or media. The narrative was so powerful that it completely displaced any form of traditional valuation. Investors weren't buying a business, they were buying a lottery ticket on a concept. They saw the stock price of companies like Pets.com or Webvan going up every day and felt the intense psychological pain of missing out. This fear of missing out, or FOMO, is the engine that drives speculative bubbles. It overrides all rational thought. The analysis becomes, it's going up, so it must be a good investment. I need to get in before it goes even higher. This is a complete inversion of Buffett's approach. Buffett asks, what is it worth, and what am I willing to pay? The 99% ask, where is the price going, and can I get on board? This leads to the disastrous behavior of buying high, fueled by greed, and selling low, crippled by fear. The disaster of this approach is that it contains no margin of safety. In fact, it often involves a negative margin of safety. When you buy a stock at a price that is completely untethered from its underlying business fundamentals, you are paying for future perfection that may never arrive. Any small disappointment, a missed earnings target, a new competitor, a change in sentiment, can cause the stock price to collapse because there is no bedrock of value to support it. The price is sustained only by hope and momentum, and these are the most fickle forces in the market. Consider the fate of investors in many of the hot meme stocks or speculative tech companies that soared in recent years. People poured their life savings into companies based on social media hype, with little to no regard for the company's revenue, profits, or balance sheet. They were part of a movement, a tribe. It was exciting. For a while it worked spectacularly. The price went up, and they felt like geniuses. But when the tide of sentiment turned, the crash was brutal and swift. Prices fell 80%, 90%, or more. This is what Buffett means by permanent capital loss. It's not a 10% correction in a solid business. It's the near total evaporation of your investment, a loss from which it is almost impossible to recover. A 90% loss requires a 900% gain just to get back to even. The path of the 99% is also characterized by a focus on complexity over simplicity. They are often drawn to intricate trading strategies, options, leverage, or esoteric financial products, believing that complexity equals sophistication. They build complex models to predict short-term price movements, forgetting that the future is fundamentally unpredictable. Buffett's approach is the opposite. He seeks simplicity. An understandable business, purchased at a reasonable price, is a far more robust strategy than a complex algorithm trying to outsmart the market's daily whims. This mistake is not limited to retail investors. Many professional fund managers fall into the same trap. They feel pressure to be constantly active, to own the story stocks that are in the headlines, because they fear looking foolish if those stocks go up without them. This is known as institutional imperative, where an organization's behavior is driven by what its peers are doing rather than by independent, rational analysis. This is why so few professional managers outperform the market over the long term. They are caught in the same psychological traps as everyone else. The consequences of following this path are devastating. It leads to a portfolio built on sand, highly vulnerable to market volatility and shifts in sentiment. It creates immense emotional stress, as your financial well-being is tied to the unpredictable and often irrational whims of the crowd. And most importantly, it exposes your hard-earned capital to the risk of catastrophic, permanent loss, destroying your chances of achieving long-term financial freedom and security. It is a siren's call, promising quick riches but delivering, for most, only painful lessons. The direct financial connection between applying a margin of safety and valuation and your long-term wealth is profound and multifaceted. It's not just a theoretical concept. It manifests in tangible, quantifiable ways on your balance sheet and in your portfolio's performance. It is the primary driver that separates mediocre returns from market-beating, wealth-compounding results over time. First and foremost, a margin of safety directly minimizes downside risk. This is the essence of capital preservation. Let's quantify this. Imagine two investors, Investor A and Investor B, each with $100,000. A market crash occurs, and the market falls by 50%. Investor A, who followed the 99% and bought popular, overvalued stocks, sees their portfolio fall by the full 50% to $50,000. Investor B, who insisted on a 50% margin of safety, bought stocks whose prices were already depressed and disconnected from the market's euphoria. Their portfolio, being less sensitive to the market sentiment, might only fall by 25% to $75,000. Now, the market recovers. For Investor A to get back to their starting point, they need a 100% return on their $50,000. For Investor B, they only need a 33% return on their $75,000. The mathematics of loss is brutal. By losing less on the downside, you require a much smaller gain on the upside just to break even. This defensive quality is the unsung hero of long-term compounding. Second, a margin of safety provides a powerful automatic source of higher returns. When you buy a stock for $50 that you believe is worth $100, you have two ways to win. The first win comes if your analysis is correct and the business performs as expected, eventually causing the market price to converge with its intrinsic value. This gap between your purchase price and the intrinsic value is pure excess return. The second, more subtle win comes from the natural growth of the business itself. As the company reinvests its earnings and grows, its intrinsic value of $100 will also grow over time. So not only do you get the benefit of the price catching up to today's value, you also get the benefit of that value itself increasing. This double tailwind effect is a direct result of buying with a large discount. It's like stretching a rubber band. The further you pull the price away from the value when you buy, the more powerful the snapback return will be. On a company's balance sheet, this principle is reflected in the concept of book value or tangible assets. When Buffett buys a company for less than its liquidation value, meaning he could theoretically shut it down, sell all the assets, pay off all the debts, and walk away with more cash than he paid for the entire company, he has a hard, quantifiable margin of safety. The business operations are essentially free. This is the ultimate form of defensive investing, where the downside is protected by cold, hard assets. Furthermore, this discipline has a profound impact on your asset allocation strategy. Because you are only willing to buy when a significant discount appears, you will often find that there are no qualifying investments. This forces you into a state of holding cash. While the 99% see cash as a wasted asset that's not earning anything, the master investor sees cash as an option. It is dry powder, a strategic asset that provides the ability to act decisively when opportunities, like the American Express situation, arise from market panic. The ability to deploy capital during a stock market crash, when everyone else is forced to sell, is perhaps the single greatest advantage an investor can have. A margin of safety discipline naturally creates this capability. It prevents you from being fully invested in an overvalued market and ensures you have the resources to take advantage of a downturn. This strategy transforms market volatility from a threat into an opportunity. For the entrepreneur or CEO, this mindset is equally critical. When considering an acquisition or a major capital expenditure, asking, "What's the margin of safety?" is paramount. What if revenue forecasts are too optimistic? What if the integration costs are higher than expected? Building in a buffer in your financial projections and deal structures is the corporate equivalent of Buffett's investment principle. It's what separates sustainable growth from reckless, debt-fueled expansion that can bankrupt a company. In essence, the margin of safety is a financial mechanism that systematically skews the odds in your favor. It reduces the impact of bad luck and errors in judgment while amplifying the rewards of patience and sound analysis. It is the financial embodiment of the ancient wisdom, heads I win, tails I don't lose much. This is the mathematical foundation of building real, enduring wealth. The second great pillar in the construction of a crash-proof portfolio shifts our focus from the price you pay to the quality of what you are buying. Even a cheap price cannot save a terrible business. Buffett's evolution as an investor is marked by his transition from buying cigar butts, mediocre businesses at dirt-cheap prices, to buying wonderful businesses at fair prices. This pillar is the concept of the indispensable business, protected by a durable competitive advantage, or what he famously calls a moat. A moat is a structural feature of a business that protects it from competitors, allowing it to earn high returns on capital for very long periods. A strong moat provides an intrinsic margin of safety that is independent of valuation. It makes a business resilient. To understand this in practice, we must look at one of Buffett's most important and instructive acquisitions, See's Candies. The story of See's is not a dramatic tale of crisis and panic like American Express. It is a quieter, more profound lesson about the enduring power of a great brand and the economics of a truly superior business. In 1972, Buffett and his partner Charlie Munger were presented with the opportunity to buy See's Candies, a well-known, family-owned chocolate company based in California. The asking price was $30 million. By the traditional valuation metrics that Buffett had used for years, metrics focused on tangible assets like inventory and factories, the company was expensive. Its book value, the hard assets on its balance sheet, was only about $8 million. The seller was asking for a price that was nearly 4 times the company's net tangible assets. The younger Buffett, the cigar butt investor, would have walked away instantly. This was no 50-cent dollar. At best, it seemed like a dollar for a dollar, or maybe even more. But Charlie Munger pushed Buffett to look deeper. He encouraged him to think not just about the assets you could count, but about the assets that were invisible yet immensely valuable. The key asset of See's Candies was not its kitchens or its delivery trucks, it was its brand, which resided in the minds of millions of customers. For decades, See's had built a reputation for quality and nostalgia. In California, giving a box of See's chocolates for Valentine's Day, Christmas, or a birthday was a deeply ingrained social ritual. When a young man went to meet his girlfriend's parents for the first time, he brought a box of See's. It was a signal of good taste and tradition. This powerful brand gave See's something extraordinary: pricing power. Buffett investigated and realized that customers were not particularly sensitive to the price of a box of See's chocolates. Whether the box cost $6 or $7 didn't really affect the purchase decision. The emotional connection to the product and the occasion far outweighed the small price difference. This meant that See's could raise its prices every year, year after year, to cover rising costs of ingredients like sugar and cocoa, and still maintain its sales volume. This is the hallmark of a fantastic business. It's a business that can increase prices without losing customers to competitors. This pricing power, rooted in the brand's moat, created a fountain of cash. Furthermore, the business required very little capital to grow. It didn't need to build massive, expensive new factories or spend fortunes on research and development. Growth came from opening a few new stores and from those steady, annual price increases. The combination of high returns on capital and low capital requirements meant that the business generated far more cash than it needed to operate. This excess cash could then be sent back to its owners, Buffett and Munger at Berkshire Hathaway, to be reinvested in other opportunities. Buffett and Munger ultimately agreed to buy the company for $25 million. Over the decades that followed, See's Candies has sent more than $2 billion in pre-tax profits to Berkshire Hathaway. It was an initial investment of $25 million that has returned over 80 times that amount in cash, and the business is still owned by Berkshire today, continuing to generate profits. See's Candies taught Buffett one of the most important lessons of his career. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price. The quality of the business itself creates a powerful, compounding margin of safety. A company like See's is inherently resilient. During a recession, people might cut back on buying a new car, but they will still buy a small, affordable luxury like a box of chocolates for a special occasion. The business is less cyclical and more predictable. Its moat protects its profitability through good times and bad, making it a cornerstone of a defensive investment strategy and a true engine for building wealth. The story of See's Candies is a masterclass in business economics, but it is also a profound lesson in psychology. The underlying principle that makes a moat so powerful is its ability to harness deeply ingrained human cognitive biases to its advantage. The most significant of these is the status quo bias, combined with the power of habit and brand association. Humans are creatures of habit. We prefer to stick with what we know and trust. The status quo bias is our tendency to prefer that things stay the same, or that the current state of affairs persists. Changing our behavior requires effort and introduces uncertainty, both of which our brains are wired to avoid. See's Candies brilliantly exploits this. For generations of Californians, buying See's was the default choice. It was the easy, trusted, and socially accepted option. Thinking about trying a different brand of chocolate for a gift introduces risk. What if it's not as good? What if the recipient doesn't like it? The simple, low-effort decision is to stick with the tried-and-true See's. The company doesn't have to win a new battle for the customer's mind on every purchase. It just has to not lose it. This is a massive competitive advantage. Closely related to this is the psychological power of brand. A brand is not just a logo or a name. It is a mental shortcut. It's a bundle of associations, memories, and emotions that exist in the consumer's mind. When a customer thinks of See's, they don't just think of chocolate. They think of quality, nostalgia, family gatherings, and positive emotions. This emotional tagging makes the brand feel like an old friend. This is why Buffett talks about See's having the ability to create a sensation in the mind of the consumer. This mental real estate is incredibly valuable and difficult for a competitor to replicate. A new chocolate company could open up next door to a See's shop, offering a similar product for a slightly lower price, and most customers would still walk into See's. Why? Because the purchase isn't just about the physical product. It's about the emotional payoff and the elimination of risk associated with the trusted brand. They are buying certainty. The pricing power that results from this brand loyalty is a direct consequence of another psychological principle, the Weber-Fechner law of psychophysics, which states that our perception of a change in a stimulus is proportional to the initial stimulus. In simple terms, a small, incremental price increase on a product we value is barely noticeable. When See's raises the price of a box of chocolates by 50 cents, it falls below the just noticeable difference for most consumers. The incremental pain of the higher price is far less than the perceived value and emotional comfort of buying the trusted brand. A commodity business, like a gasoline station, has no such luxury. A 2-cent price difference can cause a customer to drive across the street. This is the difference between a business with a moat and one without. Buffett's shift in thinking represents a maturation in his understanding of human nature. He realized that the most durable moats are not built on physical assets, but on psychological ones. They are built on habit, trust, and identity. A company that has successfully embedded itself into the culture and habits of its customers has a resiliency that can withstand economic downturns, competitive attacks, and the passage of time. When you invest in a company with a powerful moat, you are not just buying a collection of assets and a stream of earnings. You are buying a piece of a deeply entrenched psychological phenomenon. This is a critical component of a CEO mindset when evaluating investment opportunities. It moves beyond the spreadsheet to understand the human behavior that drives the numbers, which is the key to building a truly crash-proof portfolio. The moat provides a buffer against the chaos of the marketplace, ensuring a level of predictability and stability that is the foundation of long-term financial security. So how can an ordinary investor develop the skill to identify these indispensable businesses? How do you build a portfolio around companies with strong, durable moats? This is the applied mental model, the blueprint for finding and analyzing competitive advantages. This process is less about complex financial modeling and more about being a keen observer of business and human nature. It's a core discipline in advanced portfolio management. Step 1 is to start with a universe of businesses you can understand. Just as with valuation, your circle of competence is paramount. You cannot identify a moat in an industry you don't comprehend. If you're a software engineer, you might have a natural advantage in understanding technology companies. If you're a doctor, you might be better equipped to analyze healthcare businesses. Start with what you know. This is a fundamental risk management technique. Step 2 is to actively search for the signs of a moat. There are several distinct types of competitive advantages to look for. The first, as we saw with C's, is an intangible asset moat. This is often a strong brand, but it can also be a patent or a regulatory license. Ask yourself, does this company have a name that allows it to charge more for a product that is functionally similar to its competitors? Coca-Cola is a classic example. Its formula for sugar water is not magical, but its brand is so powerful that people will pay a premium for it all over the world. The second type of moat is a switching cost moat. This exists when it is too expensive, time-consuming, or risky for a customer to change from one provider to another. Think about the bank where you have your primary checking account. Moving all your direct deposits, automatic bill payments, and linked accounts to a new bank would be a massive headache. Even if another bank offers a slightly better interest rate, most people won't switch. For entrepreneurs and CEOs, building high switching costs into your business model is a key to long-term success. In the investment world, you look for companies whose customers are locked in. Many enterprise software companies have this kind of moat. Once a corporation builds its entire workflow around a particular software suite, the cost and risk of switching to a competitor are immense. The third type of moat is the network effect. This is a powerful advantage that exists when a product or service becomes more valuable as more people use it. Social media platforms like Facebook or professional networks like LinkedIn are classic examples. The value of being on Facebook is that all your friends are there. A new social network could have better features, but it's useless without the users. Credit card companies like Visa and American Express also benefit from a two-sided network effect. Merchants accept Visa because billions of customers have Visa cards, and customers carry Visa cards because millions of merchants accept them. This creates a powerful, self-reinforcing cycle that is incredibly difficult for a newcomer to break into. The fourth type of moat is a cost advantage. This can come from two primary sources: process or scale. A process advantage means a company has a unique, proprietary way of doing something that allows it to deliver a good or service cheaper than anyone else. A scale advantage means that a large company can produce things so cheaply that it can undercut any smaller competitor on price and still be profitable. A company like Walmart, with its massive logistical and purchasing power, is a prime example. Step 3 is to test the strength and durability of the moat. It's not enough to identify a potential moat. You must assess its resilience. Ask critical questions. Is this moat widening or narrowing? For example, the brand moat of a traditional newspaper has been dramatically narrowed by the internet. Conversely, the network effect moat of a company like Amazon has been consistently widening as more buyers and sellers join its platform. How long will this advantage last? A patent provides a powerful but temporary moat that will eventually expire. A deeply ingrained brand can last for a century. What could destroy this moat? A change in technology, a shift in consumer behavior, or new government regulation could all potentially drain a company's moat. A key part of your analysis is to think like an attacker. If you were a well-funded competitor, how would you try to breach this company's defenses? The harder it is to come up with a viable answer, the stronger the moat. Step 4 is to look for the evidence in the financial statements. A strong moat should leave fingerprints all over the numbers. Companies with durable competitive advantages typically have consistently high returns on invested capital, ROIC, or returns on equity, ROE. They are able to earn profits well above their cost of capital. They should also display stable or rising gross margins, which is evidence of pricing power. If a company can maintain its profitability without having to constantly engage in price wars, it's a strong sign of a competitive advantage. This blueprint provides a structured way to think about business quality. By focusing your capital on businesses protected by one or more of these powerful moats, you are building a portfolio with an inherent structural defense. These companies are more predictable, more resilient in downturns, and have a greater capacity to compound their value over the long term. This is the essence of defensive investing and a cornerstone of building lasting financial security. To fully grasp the strategic importance of investing in businesses with moats, we must examine the alternative, the path of the 99%, which involves investing in what can be called commodity businesses. This is the antithesis of the indispensable business, and it is a graveyard for investment capital. A commodity business is one that sells a product or service that is virtually indistinguishable from its competitors. The only thing that truly matters to the customer is price. Think of airlines, gas stations, steel manufacturers, or basic agricultural products. In these industries, there is little to no brand loyalty and zero switching costs. The customer will simply buy from whoever offers the lowest price. This creates a brutal and relentless competitive environment. Investing in these types of businesses is incredibly difficult and risky. Their profitability is often cyclical and unpredictable. When times are good and demand is high, they might make decent money. But this profitability attracts new competitors who add new capacity to the industry. Soon, supply outstrips demand, leading to vicious price wars where everyone cuts prices to maintain market share. Profits evaporate, and companies can face years of losses. The average investor is often lured into these businesses during the good times. They see a company posting record profits and a rising stock price and jump in, not realizing that these profits are temporary and unsustainable. They mistake the top of a business cycle for a permanent state of affairs. This is a classic value trap. The stock might look cheap on a PE basis using its peak earnings, but those earnings are about to collapse. Buffett himself has called airlines a, quote, death trap for investors. For decades, the industry has been characterized by intense competition, high fixed costs, planes, labor, fuel, and brutal price wars. A new airline can start up with a few leased planes and immediately put pressure on the prices of established carriers. There is no customer loyalty. Travelers will almost always choose the cheapest flight that fits their schedule. As a result, the history of the airline industry is littered with bankruptcies. The money that has been made by airline companies over a century is dwarfed by the total amount of capital that investors have lost. Another common mistake the 99% make is falling for what is known as diversification. They buy into massive, sprawling conglomerates that are involved in dozens of different unrelated commodity businesses. The company might look impressive and diversified on the surface, but in reality, it's just a collection of mediocre operations, none of which have a real competitive advantage. These companies often struggle to earn returns above their cost of capital, and their stock prices go nowhere for decades. The management of these businesses is perpetually trapped in a cycle of restructuring, cost-cutting, and fighting for tiny slivers of market share. There is no pricing power, no customer loyalty, and no long-term stability. It is a constant, grinding battle for survival. Compare this to the serene, predictable profitability of a company like See's Candies. The path of the 99% is also filled with companies that are susceptible to rapid technological disruption. Businesses with no moat are like sandcastles, vulnerable to being washed away by the next technological tide. Think of companies like Blockbuster Video or Kodak. They dominated their industries for decades, but they had no durable competitive advantage that could protect them from a fundamental shift in technology, In their cases, streaming video and digital photography. Investors who held these stocks lost everything because they failed to assess the durability of the business model. They saw a history of strong profits and assumed it would continue forever, without asking the critical question: what protects this business from a smarter, faster, cheaper competitor? The financial consequences of investing in moatless businesses are severe. Portfolios become highly volatile, whipsawed by economic cycles and competitive pressures. The potential for permanent capital loss is significantly higher. And the long-term compounding of wealth is nearly impossible, as any period of profitability is inevitably competed away. Avoiding these businesses is just as important as identifying the great ones. It is a critical risk management discipline that protects your capital and ensures that the money you invest is being put to work in fertile ground, where it has the potential to grow and compound for many years to come. The direct financial connection between investing in businesses with strong moats and superior portfolio performance is clear and quantifiable. This principle of focusing on quality directly translates into better returns, lower risk, and greater financial security. Let's break down how this manifests financially. The most direct impact is on a company's profitability metrics, specifically its return on invested capital, or ROIC. ROIC measures how efficiently a company is using the capital invested in its operations to generate profits. A business in a highly competitive, moatless industry might struggle to earn an ROIC of 5 to 7%, which is barely above its cost of capital. A business with a strong moat, like a dominant software company or a powerful consumer brand, can consistently generate an ROIC of 20%, 30%, or even higher. This difference is the financial expression of a competitive advantage. High ROIC is the engine of compounding. A company that can consistently reinvest its earnings at a high rate of return will see its intrinsic value grow exponentially over time. Consider two companies, each with an intrinsic value of $100 per share. Company A is a moatless business that earns a 6% return on its capital. Company B has a strong moat and earns a 20% return. After 10 years of reinvesting their profits, Company A's intrinsic value might have grown to $179. Company B's intrinsic value, however, will have exploded to over $619. The moat is the direct cause of this massive divergence in wealth creation. As an owner of the stock, this growth in intrinsic value will eventually be reflected in the stock price, leading to significant capital gains. Furthermore, a moat provides tremendous financial stability and predictability. This reduces the risk profile of your portfolio. A company with pricing power and loyal customers will have a much smoother and more reliable stream of earnings than a company whose fate is tied to volatile commodity prices or brutal price wars. This predictability allows for more accurate valuation and reduces the chance of negative surprises. In your portfolio, this translates to lower volatility. Stocks of high-quality, moated businesses tend to decline less during market downturns because investors recognize their resilience and are less likely to sell them in a panic. This defensive characteristic is a cornerstone of capital preservation. The financial structure of a moated business is also typically much stronger. Because they generate so much cash, these companies rarely need to take on large amounts of debt. They can fund their growth internally. This results in a fortress-like balance sheet, which is another layer of safety for the investor. A company with little to no debt cannot go bankrupt. This financial strength also gives them options that weaker competitors don't have. During a recession, a moated business can continue to invest in marketing, acquire weaker rivals at bargain prices, and gain market share. This allows them to exit a downturn even stronger than they entered it. This is a crucial element for any entrepreneur or CEO to understand. A strong competitive position is what provides strategic flexibility and the ability to play offense when everyone else is playing defense. From an asset allocation perspective, concentrating your portfolio in a collection of businesses with durable moats is a proven strategy for long-term outperformance. It is a form of active management that relies on qualitative business analysis rather than short-term market timing. It aligns your investment strategy with the fundamental principles of wealth creation, owning productive assets that are sheltered from the destructive forces of competition. The ultimate financial benefit is achieving your goal of financial freedom with greater certainty and peace of mind. By building a portfolio of indispensable businesses, you are creating a stream of income and growth that is not dependent on the whims of the market or the state of the economy. You are owning a collection of robust, cash-generating machines that will work for you year after year, protecting your capital and compounding your wealth through any market environment. This is the financial power of the moat, the second great pillar of a truly crash-proof investment philosophy. We have established the importance of valuation and the quality of the business. The third pillar of a crash-proof portfolio provides a crucial boundary for these first two principles. It is the intellectual margin of safety, a concept Buffett calls the circle of competence. The idea is deceptively simple. You don't have to be an expert on every company, or even many. You only have to be able to correctly evaluate the companies you do invest in. Therefore, you must define the perimeter of your own knowledge and stay strictly within it. Investing outside of your circle of competence is not investing, it is speculation. The most powerful foundational anecdote for this principle is not a single brilliant investment Buffett made, but rather the thousands of brilliant investments he chose not to make during the heights of the dot-com bubble from 1998 to early 2000. This period was one of the most euphoric and ultimately destructive manias in market history. A new paradigm had supposedly emerged, centered around the internet. Technology companies, many with fantastical ideas but no profits or even revenues, were soaring to astronomical valuations. The Nasdaq index, full of these tech darlings, more than doubled in a single year. Established, old economy businesses, the kind Buffett owned and understood, were dismissed as relics. Berkshire Hathaway's stock lagged the market badly. Buffett was openly mocked. He was called a dinosaur, a man who didn't get it. Barron's, a major financial publication, ran a cover story in 1999 titled, "What's Wrong, Warren?" The article questioned if he had lost his touch, if his value-oriented, simple business approach was obsolete in the new, high-tech world. The pressure on him was immense. His own shareholders were questioning him. He was underperforming his peers by a staggering margin. Every day, the financial news was filled with stories of 20-somethings becoming billionaires overnight by investing in companies whose business models were indecipherable. It would have been easy for him to capitulate. He could have easily justified buying a basket of tech stocks to hedge his bets and quiet the critics. But he didn't. He steadfastly refused to invest in these companies for one simple reason: he didn't understand them. He admitted, publicly and without shame, that he had no special insight into which of the hundreds of new technology companies would be the long-term winners. He couldn't reliably project their cash flows 10 or 20 years into the future. He couldn't assess their competitive moats in a rapidly changing technological landscape. Because he couldn't value them with any degree of confidence, he couldn't determine if he was buying them with a margin of safety. So he did nothing. He sat patiently, holding cash and sticking to the businesses he understood, like Coca-Cola, Gillette, and insurance. From the outside, it looked like he was missing the party of a lifetime. His adherence to his circle of competence was seen as a weakness, a failure to adapt. But in reality, it was his greatest strength. It was his ultimate risk management tool. When the bubble burst in March of 2000, the carnage was biblical. The Nasdaq index collapsed by nearly 80% over the next 2 years. Companies that had been worth billions saw their stock prices go to zero. Trillions of dollars of speculative wealth vanished. The new paradigm was revealed to be the same old speculative mania dressed in new clothes. Investors who had chased the hype, who had ventured far outside their own areas of expertise, were financially annihilated. Meanwhile, Berkshire Hathaway's portfolio of dinosaur companies held up remarkably well. And the cash that Buffett had patiently held became immensely valuable, allowing him to provide capital to struggling but solid businesses on highly favorable terms in the aftermath of the crash. His reputation was not just restored, it was elevated to legendary status. His refusal to participate in the mania was not a failure to adapt, it was a profound act of intellectual discipline. The circle of competence is a recognition of the limits of one's own knowledge. It's the humility to say, "I don't know." In a world that rewards the appearance of certainty, this is an incredibly powerful and rare trait. Buffett's performance during the dot-com bust demonstrates that the greatest financial risk is not missing out on a winning stock. It's investing in something you don't understand and suffering a permanent loss of capital. Protecting your portfolio isn't just about what you own. It's about what you choose not to own. Your circle of competence is the fence that keeps you from wandering into the minefield of speculation. The psychological principle underpinning the circle of competence is a direct counter-assault on one of the most pervasive and dangerous cognitive biases, the Dunning-Kruger effect, amplified by the fear of missing out, FOMO. The Dunning-Kruger effect is a bias in which people with low ability at a task overestimate their ability. In essence, they are too incompetent to recognize their own incompetence. This is rampant in investing. After a few successful trades in a bull market, an amateur investor can begin to feel like a genius. The market's rising tide lifts all boats, but the investor attributes the success to their own skill rather than to luck or the broader market trend. This overconfidence leads them to believe they can pick winners in any industry, regardless of their actual knowledge. They hear about a hot biotech stock or a revolutionary cryptocurrency, and their newfound overconfidence convinces them they can analyze it as effectively as a seasoned expert. They venture far outside any reasonable definition of their own competence, believing they have a special insight that others lack. This is where the Dunning-Kruger effect becomes a gateway to financial disaster. This bias is then supercharged by the fear of missing out. As we saw in the dot-com anecdote, watching others get rich from investments you don't own creates a powerful and painful emotional response. It's a combination of envy, regret, and anxiety. Your brain tells you that you are falling behind, that you are making a mistake by being prudent. This emotional pressure makes it incredibly difficult to stick to a disciplined strategy. The temptation to join the herd, to buy the hot stock that everyone is talking about, becomes almost irresistible. The narrative is always, "This time is different." This phrase is used to justify abandoning time-tested principles of valuation and business analysis in favor of a new, exciting story. FOMO is the enemy of rational thought. It short-circuits the analytical part of your brain and activates the emotional, reactive part. It causes you to make decisions based on social pressure and price momentum rather than on intrinsic value and business fundamentals. Buffett's adherence to his circle of competence is a deliberate, conscious strategy to neutralize these two psychological poisons. By predefining the boundaries of his knowledge, he creates a clear, objective rule for his decision-making. The question is no longer an emotional, "Am I missing out?" but a rational, "Is this business inside my circle of competence?" If the answer is no, the analysis stops. There is no temptation, no need to justify inaction. The rule is the rule. This is a powerful form of what psychologists call a commitment device, or a Ulysses contract. In Homer's Odyssey, Ulysses wanted to hear the sirens' beautiful, irresistible song, but he knew that if he heard it, he would steer his ship into the rocks. So he had his men tie him to the mast and plug their own ears with wax. He pre-committed to a course of action that would protect him from his future, irrational self. The circle of competence is an investor's way of tying themselves to the mast. You are acknowledging that you will face the temptation of the market's siren song, and you are putting a system in place beforehand to prevent yourself from succumbing to it. It is an act of profound intellectual humility. It is the recognition that the world is a complex place and that true expertise is narrow and deep, not broad and shallow. This mindset is a core tenet of a successful CEO mindset, or an entrepreneur's strategy. A successful company doesn't try to be everything to everyone. It focuses on what it does best, its core competency, and builds a defensible position around that. The same discipline applies to building a portfolio. True wealth management is not about chasing every opportunity. It's about selectively engaging in the few opportunities that you are uniquely qualified to understand and analyze. This discipline is the ultimate defense against the market's manias and the psychological biases that lead so many to ruin. How does one practically define and operate within their own circle of competence? This isn't an abstract philosophical concept, it's a tangible tool for risk management. Here is the applied mental model, the blueprint for building and respecting your intellectual margin of safety. Step 1 is the self-assessment and definition phase. You need to perform an honest and brutal audit of your own knowledge and experience. Take out a piece of paper and create 2 columns. I am an expert in, and I am familiar with. The expert column is for subjects where you have deep, practical, hands-on knowledge. This could be from your profession, a serious long-term hobby, or extensive, dedicated study. For example, if you've been a retail store manager for 20 years, you likely have an expert-level understanding of retail logistics, merchandising, and consumer behavior. That is the core of your circle. The familiar column is for topics you know something about but lack true, deep insight. Maybe you follow technology and read tech blogs, so you're familiar with the big tech companies, but you don't have the expertise to dissect their semiconductor designs or cloud architecture. Be brutally honest. Most of your knowledge will fall into the familiar category. Your circle of competence is primarily the expert column. Step 2 is to create an absolutely not list. This is just as important. List the industries and types of businesses you know you will never understand. For many investors, this might include things like biotechnology, complex financial derivatives, or mineral exploration companies. These are businesses that require highly specialized, technical knowledge to evaluate. By explicitly listing them as off-limits, you are pre-committing to avoid them, no matter how exciting the story sounds. This list acts as a crucial filter, saving you time and protecting you from your own potential overconfidence. Step 3 is to develop a rigorous checklist for any potential investment. This checklist should be your gatekeeper. Before you even begin a deep dive into a company's financials, you must be able to answer a series of qualitative questions about it. Your checklist should include questions like, can I explain how this business makes money, in simple terms, to a 10-year-old? Do I understand the key economic drivers of this business and its industry? Do I have a good grasp of the competitive landscape and what makes this company better than its rivals? Do I have a clear understanding of the major risks facing this business over the next 10 years? If you cannot answer these questions confidently and without resorting to vague jargon, the company is outside your circle of competence. End of story. Move on. This discipline prevents you from getting seduced by a cheap-looking stock in a business you don't truly comprehend. Step 4 is to actively work on expanding your circle, but to do so slowly and deliberately. The goal is not to have a static circle for your entire life. You can and should learn about new industries, but you must do it the right way. Choose an industry that interests you and commit to becoming a true student of it. Read books, industry trade journals, and the annual reports of multiple companies within that sector. Follow the industry's thought leaders. The goal is to learn the business, not just the stocks. You want to understand the unit economics, the competitive dynamics, and the long-term trends. Only after you have put in the hard work and can confidently say, the industry is now inside your circle, should you even consider making an investment. A crucial rule for expansion is to stick to the edges of your current circle. If your expertise is in retail, perhaps you can expand into consumer packaged goods, as the two are closely related. It's a much smaller and safer leap than jumping from retail to enterprise software. This methodical approach to learning is a core component of a professional investment strategy and a key differentiator from the amateur who jumps from one hot trend to the next. By following this blueprint, you transform the circle of competence from a vague idea into a robust operational system for risk management. It forces discipline, promotes intellectual humility, and ensures that when you do make an investment, you are operating from a position of true knowledge and strength. This is the foundation of capital preservation and the key to avoiding the catastrophic mistakes that can derail your journey to financial freedom. The antithesis to operating within a circle of competence is the path of the 99%, the path of the know-it-all speculator. This is an approach characterized by intellectual arrogance, a lack of discipline, and a constant chase after the next big thing, regardless of one's understanding of it. The 99% approach starts with the news, not with knowledge. The investor sees a story on a financial news network or a viral post on social media about a company in a hot sector. Perhaps it's a company working on gene editing, artificial intelligence, or flying cars. The story is exciting and futuristic. The stock price is already soaring. The feeling of FOMO kicks in immediately. The speculator, driven by greed and a fear of being left behind, decides they need to get in on the action. There is no honest self-assessment of their knowledge. They may have no background in biology, but they convince themselves they can pick the winning gene editing company. They may not know how to code, but they believe they can identify the dominant AI platform of the future. This is the Dunning-Kruger effect in its most dangerous form. A little bit of surface-level knowledge, gleaned from a few articles or videos, creates a powerful illusion of expertise. This speculator disdains the boring businesses that are easy to understand. They see companies that sell soap or soda as relics of a bygone era. They believe that massive wealth can only be created by investing in complex, cutting-edge technologies. They mistake complexity for sophistication and a good story for a good business. Their research process, if it can be called that, is shallow and confirmatory. They don't seek to understand the risks. They seek information that confirms their initial desire to buy the stock. They read bullish analyst reports and ignore the bearish ones. They frequent online forums where other speculators are hyping the stock, creating a powerful echo chamber of social proof. This behavior is the polar opposite of the disciplined, skeptical analysis required for true investing. The portfolio of such a speculator is not a carefully curated collection of well-understood businesses. It is a chaotic grab bag of lottery tickets. It might contain a speculative biotech stock, a volatile cryptocurrency, a risky mining exploration company, and a cash-burning tech startup. There is no unifying philosophy, other than the hope that one of them will hit it big. This is not a strategy for building wealth. It is a recipe for high-stress gambling. The consequences of this approach are predictably disastrous. Because the speculator does not truly understand the businesses they own, they have no basis for their conviction other than the stock price itself. When the stock price is going up, they feel brilliant. But when the inevitable downturn comes, when a clinical trial fails, a product launch disappoints, or market sentiment simply shifts, they are left in a state of terror. They have no way to determine if the price drop is a temporary setback or a sign of permanent business impairment. They have no calculated intrinsic value to anchor their decision-making. Their only guide is the red arrow on the screen. Inevitably, they panic and sell at or near the bottom, locking in a devastating loss. They then repeat the cycle, chasing the next hot story, hoping for a different outcome. This path is a surefire way to destroy capital over the long term. It violates the most fundamental principles of risk management. It is a strategy built on hope and hubris rather than knowledge and humility. It is the rejection of the one principle that could save them, admitting what they don't know. The discipline of staying within a circle of competence is the firewall that protects an investor from this self-destructive cycle, creating the intellectual conditions necessary for long-term financial security. The direct financial connection between rigorously adhering to a circle of competence and the health of your portfolio is one of the most important, yet often overlooked, drivers of long-term returns. Its impact is primarily defensive, but this defense is what allows for successful offense over time. The primary financial benefit is the dramatic reduction of unforced errors, specifically the avoidance of permanent capital loss. Think of an investment portfolio like a ship on a long voyage. A 10% or 20% loss from a good, understandable business hitting a rough patch is like a storm that damages the sails. It's a setback, but it can be repaired, and the journey can continue. A 90% loss from investing in a speculative, misunderstood business that goes bankrupt is like hitting an iceberg. It sinks the ship. The voyage is over. The power of compounding is completely destroyed. By staying within your circle of competence, you are essentially using a high-tech sonar system to navigate away from the icebergs. You are eliminating the investments where the risk of total failure is highest because you lack the expertise to properly assess them. This is the essence of capital preservation. On a practical level, this discipline leads to a higher "batting average." Because you are only swinging at pitches in your sweet spot, investments in businesses you deeply understand, your odds of making a successful investment are significantly higher. You are better able to assess the business's moat, management quality, and future prospects. This leads to a portfolio with fewer zeros and more consistent, predictable winners. While you might miss some spectacular home runs outside your circle, you will also avoid the strikeouts that can cripple your overall performance. This approach also has a significant impact on your behavior, which in turn has a direct financial consequence. When you own businesses you understand, you are less likely to panic during a market crash. If the stock of a company you know inside and out falls by 30%, you can rationally reevaluate its long-term prospects. If the fundamentals are still intact, you might even see the price drop as an opportunity to buy more at a better price. This is the behavior of a professional investor. Conversely, if you own a complex biotech stock you don't understand, and it falls 30%, your only information is the price action. Fear takes over, and you are far more likely to sell at the worst possible time. The financial result is that a circle of competence allows you to buy low and a lack of one causes you to sell low. The difference in long-term wealth creation between these two behaviors is astronomical. Furthermore, this discipline improves your asset allocation. By forcing you to say no to most opportunities, it concentrates your capital into your very best ideas. A portfolio of 10 to 15 well-understood, high-conviction investments is likely to be far more robust and perform better than a portfolio of 50 or 100 speculative positions that are little more than guesses. This concentrated approach, made possible by deep expertise, is a hallmark of many of the world's greatest investors. It's a strategy for entrepreneurs and CEOs as well. The most successful companies stick to their core competencies. They don't chase fads. This focus allows them to build deep, defensible moats and generate superior returns on capital. The financial security of the enterprise is built on this intellectual discipline. Ultimately, the financial connection is about maximizing the power of compounding by minimizing catastrophic interruptions. Compounding is a fragile process. A single, massive loss can undo years of patient gains. The circle of competence is your most powerful shield, ensuring that your capital remains in the game, working for you, and compounding steadily toward your goal of financial freedom. It is the intellectual foundation upon which a truly crash-proof portfolio is built. We arrive now at the fourth pillar, a principle that addresses the structural integrity of a business and, by extension, your investment in it. This pillar is about recognizing that debt is the enemy. A business, no matter how wonderful its operations or how wide its moat, can be destroyed by a reckless balance sheet. Buffett has a deep-seated aversion to excessive leverage, both in the companies he buys and in his own operations at Berkshire Hathaway. He understands that debt magnifies both gains and losses, but its true danger lies in its ability to take away a company's staying power. A foundational anecdote that illustrates this danger is not one of Buffett's successes, but one of his most admitted mistakes: the acquisition of Dexter Shoe Company. This story is a powerful lesson because it involves a great business that was ultimately undone by the weapon Buffett chose to pay with, a form of leverage that taught him an invaluable lesson. In 1993, Berkshire Hathaway acquired Dexter Shoe for $433 million. Dexter was a high-quality American shoe manufacturer with a strong brand and a long history of profitability. It seemed like a classic Buffett-style business. The critical mistake was not in identifying the business, but in how he paid for it. Instead of paying with cash, Buffett paid for Dexter entirely with Berkshire Hathaway stock. At the time, he thought this was a clever move. He was essentially trading his own highly valued paper for Dexter's assets. He viewed this as a transaction without risk. However, this was a profound miscalculation. Paying with stock is a form of leverage. You are using your own company's equity, which has its own intrinsic value, to make a purchase. What Buffett soon discovered was that Dexter's competitive moat was not as durable as he thought. In the years following the acquisition, a flood of cheap, foreign-made shoes began to enter the U.S. market. Dexter's domestic manufacturing cost structure simply couldn't compete. Its profitability collapsed, and eventually, the entire business became worthless. Now, if Buffett had paid cash for Dexter, it would have been a $433 million loss. A painful mistake, but one that Berkshire's massive earnings power could easily absorb. But because he had paid with Berkshire stock, the true cost of the mistake was magnified enormously. The shares of Berkshire that he gave to the Dexter sellers, which were worth $433 million in 1993, would, over the next couple of decades, become worth billions of dollars. In his 2007 letter to shareholders, Buffett calculated that the cost of this mistake had compounded to over $3.5 billion. He called it his worst deal ever, by far. What is the connection to debt? Paying with overvalued stock is conceptually similar to using borrowed money. You are using an asset that has a high current price but also a high opportunity cost. The lesson Buffett learned was that debt, in any form, removes your margin of safety when it comes to time. A business facing operational challenges, like Dexter was with foreign competition, needs time to adapt and restructure. If the business has a strong balance sheet with little to no debt, it has that time. It can weather years of losses if necessary. But if a business is heavily indebted, it does not have the luxury of time. It must make regular interest and principal payments to its creditors, no matter how bad its business is. A single bad year or a tough recession can trigger a default, forcing the company into bankruptcy. The creditors take over, and the equity owners, the stockholders, are completely wiped out. The underlying good business might not have been fatally flawed, but the debt on its balance sheet made a temporary problem a permanent one. This is why Buffett insists on a, quote, fortress balance sheet at Berkshire Hathaway. He always maintains a massive cash position, far more than is needed for daily operations. This isn't inefficient. It's a strategic asset. It ensures that Berkshire can survive any conceivable economic catastrophe and that it will never be at the mercy of its creditors or the capital markets. The Dexter shoe story is his permanent reminder that even a good business can be a catastrophic investment if the financial structure is fragile. An over-leveraged balance sheet is the financial equivalent of building a beautiful mansion on a foundation of sand. The first storm that comes along will bring the whole thing crashing down. For an investor, analyzing a company's debt load is not a secondary task. It is a primary component of risk management and a crucial pillar in building a crash-proof portfolio. The psychological drivers that lead both corporate managers and individual investors to embrace excessive debt are powerful and deeply rooted in human nature. The core principle is the seductive allure of the get-rich-quick instinct, a manifestation of our brain's preference for immediate gratification over long-term stability. This is the concept of hyperbolic discounting in behavioral economics. We have a tendency to place a much higher value on a reward that is closer to the present moment than one that is further in the future, even if the future reward is objectively larger. Debt and leverage are financial tools that cater directly to this bias. For a CEO or an entrepreneur, using debt to finance an acquisition or a major expansion promises faster growth now. The potential rewards are immediate and visible: higher revenues, larger market share, a rising stock price. The risks associated with that debt, the restrictive covenants, the inflexible interest payments, the loss of resilience during a downturn, are abstract, probabilistic, and in the future. The brain's emotional, short-term focused system overpowers the rational, long-term planning system. It's the same reason people choose a slice of cake today over the long-term benefit of good health. The immediate pleasure of the cake is more compelling than the distant reward of a longer life. For an investor, this same bias manifests as the temptation to use margin loans to buy more stock. The potential upside is magnified. If you invest $10,000 of your own money and the stock goes up 10%, you make $1,000. If you borrow another $10,000 and invest $20,000, the same 10% move makes you $2,000. The appeal is obvious and intoxicating. It feels like a shortcut to financial freedom. This desire is amplified by overconfidence bias. In a bull market, when everything is going up, people forget that stocks can also go down. They start to believe that their success is due to skill and that they can predict the market's direction. This overconfidence makes taking on leverage feel less risky. They think, I know this stock is a winner, so using margin to buy more is just being smart and aggressive. This combination, the desire for immediate outsized gains and an overestimation of one's own predictive abilities, is a lethal cocktail. It blinds investors and managers to the true nature of debt. Debt introduces fragility. It creates a point of no return. With an unleveraged investment, you can be wrong about the timing and still be right about the investment. A good company's stock can go down and stay down for years, but as long as the company is financially sound, you can afford to wait for it to recover. Debt takes away the ability to wait. A margin call forces you to sell at the worst possible time. A debt covenant can force a company into bankruptcy because of a temporary business problem. Buffett's aversion to debt is a conscious and deliberate rejection of this psychological trap. His philosophy is built on the idea of getting rich slow. He prioritizes survival and staying power above all else. He is willing to accept lower, more certain returns in the short term to guarantee the survival of his enterprise for the long term. This is a mindset that is deeply unnatural for the human brain, which is wired for speed and immediate results. It requires a cultivated patience and a deep respect for risk. By avoiding debt, Buffett is creating a psychological margin of safety. He is ensuring that he will never be forced to make a decision out of desperation. He can always operate from a position of strength and rationality, even in the midst of a crisis. This is a key part of the CEO mindset that is essential for long-term capital preservation and wealth management. It is the understanding that the ability to endure is the ultimate competitive advantage. How can a retail investor systematically analyze a company's debt and incorporate this pillar into their stock-picking process? This is the blueprint for a financial health checkup, a critical component of defensive investing that will help you avoid the fragile companies destined to fail. Step 1 is to find the balance sheet. In a company's annual 10K or quarterly 10Q report, the balance sheet is one of the three main financial statements. It provides a snapshot of what the company owns, assets, and what it owes, liabilities. You are looking for the line items that represent debt. These will typically be labeled short-term debt and long-term debt. Add these two numbers together to get the company's total debt. Step 2 is to put the debt in context. $1 billion in debt might be a crushing load for a small company, but a trivial amount for a massive one. You need to compare the debt to other financial metrics. The first and most common ratio is the debt-to-equity ratio. You find the total shareholders' equity on the balance sheet and divide the total debt by this number. A ratio of 1.0 means the company is financed with equal parts debt and equity. A ratio below 0.5 is generally considered conservative and healthy. A ratio above 2.0 suggests a high degree of leverage and should be seen as a major red flag, requiring much deeper investigation. Step 3 is to assess the company's ability to service its debt. It's not just the amount of debt that matters, but the company's ability to make the interest payments. For this, you need to look at the income statement. Find the operating income, or EBIT, earnings before interest and taxes. Then find the interest expense. The interest coverage ratio is calculated by dividing the operating income by the interest expense. This ratio tells you how many times the company's operating profit can cover its annual interest payments. A ratio of 5x or higher is very strong. It means the company's profits could fall by 80% and it would still have enough money to pay its lenders. A ratio below 2x is a danger sign. It indicates that a small drop in profitability could put the company at risk of default. This is a crucial stress test for your investment ideas. Step 4 is to look at the debt's maturity schedule. A company might have a lot of debt, but if it doesn't come due for another 20 years, it's less of an immediate risk than the same amount of debt that is due next year. In the footnotes of the annual report, companies are required to disclose a schedule of their debt maturities. Look for a large cliff where a huge amount of debt is coming due in a single year in the near future. This can create a significant refinancing risk, especially if interest rates have risen or the company's business has weakened. Step 5 is to examine the trend. Is the company's debt level increasing or decreasing over time? Go back and look at the balance sheets from the past 5 or 10 years. A company that is steadily paying down its debt and strengthening its balance sheet is a positive sign of disciplined management. A company whose debt is ballooning year after year is a major warning. This trend analysis provides insight into the financial philosophy of the company's leadership. Are they conservative stewards of capital or aggressive risk takers? This systematic checkup is a non-negotiable part of a professional investment strategy. It acts as a powerful filter, immediately screening out the financially weak and fragile companies from your potential investment universe. By making a healthy balance sheet a prerequisite for any investment, you are building a structural layer of safety into your portfolio. You are ensuring that the companies you own have the staying power to survive unforeseen challenges and the financial flexibility to thrive over the long term. This is a foundational practice for capital preservation and a key step towards achieving genuine financial security. The antithesis of a debt-averse strategy is the path of the 99%, which is often characterized by a blind admiration for aggressive, debt-fueled growth. This path is seductive because, for a time, it can produce spectacular results, but it almost always ends in disaster. The 99% view debt not as a danger, but as a tool for rapid expansion and a sign of ambition. They are drawn to companies that are constantly making headlines with large, debt-financed acquisitions. This empire building is often celebrated by the financial media and unsophisticated investors. The CEO is hailed as a visionary, a bold risk-taker. The rising revenue and earnings per share figures, often artificially boosted by the acquisitions, create an illusion of brilliant performance. The problem is that this growth is often fragile and unprofitable. The company becomes a, quote, serial acquirer, constantly needing to do bigger and bigger deals to keep the growth story alive. The balance sheet becomes bloated with debt and goodwill, an intangible asset that represents the premium paid over the book value of the acquired companies. This creates a ticking time bomb. All it takes is one bad acquisition or one economic downturn, and the entire edifice can collapse. The high-interest payments consume all the cash flow. The company can no longer make new acquisitions to prop up its growth, and the goodwill on the balance sheet has to be written down, leading to massive reported losses. The stock price, which was built on the story of perpetual growth, plummets. Investors who were cheering the visionary CEO are wiped out. A classic example of this is the downfall of many companies in the telecommunications sector in the early 2000s, after the dot-com bust. Companies like WorldCom had used massive amounts of debt to acquire dozens of other companies, rolling them up into a giant. When the growth slowed, they resorted to accounting fraud to hide the financial rot. But the underlying problem was a business model built on unsustainable, debt-fueled expansion. The retail investor who falls for this trap often makes a critical mistake. They focus only on the income statement, the growth story, and completely ignore the balance sheet, the financial risk. They see rising sales and get excited, without asking the crucial question, how is this growth being financed? On a personal level, the 99% often apply the same flawed logic. They see leverage as the fast track to wealth. They take out maximum margin loans to invest in the stock market, they buy real estate with little or no money down, or they take on significant debt to start a business without a proven concept. They are focused exclusively on the potential upside. They dream of what will happen if the stock price doubles or the real estate market booms. They spend almost no time considering what will happen if they are wrong. What happens if the stock market crashes and they get a margin call? What happens if the real estate market turns and they are underwater on their mortgage? What happens if the new business fails to generate revenue and they can't make the loan payments? This failure to invert, to first consider the downside, is the hallmark of the amateur speculator. The consequences are life-altering. A margin call can wipe out a lifetime of savings in a matter of days. A foreclosure can destroy one's credit and financial stability for years. A failed, debt-laden business can lead to personal bankruptcy. The path of the 99% is a high-wire act with no safety net. It is a gamble that one's optimistic forecasts will come true, with no room for error or bad luck. It is the polar opposite of the resilient, defensive, and sustainable approach to building wealth that is essential for achieving long-term financial freedom. The direct financial connection between a conservative approach to debt and your financial outcomes is one of the most powerful forces in wealth creation. A low debt or no debt policy, both in the companies you invest in and in your own financial life, creates tangible advantages that manifest directly in your portfolio's performance and stability. First, it dramatically lowers the volatility of your portfolio. Companies with strong balance sheets are simply less risky. Their stock prices tend to be more stable and less susceptible to the wild swings of market sentiment. During a stock market crash or a recession, investors flock to safety. They sell the highly leveraged, speculative companies and buy the financially sound, blue-chip companies. This flight to quality means that a portfolio composed of low-debt companies will likely decline significantly less than the overall market during a downturn. As we've seen, losing less on the downside is a massive mathematical advantage for long-term compounding. This is the essence of building a crash-proof portfolio. Second, a debt-averse strategy creates immense strategic opportunities. A company with a fortress balance sheet, flush with cash, can act as the buyer of last resort during a crisis. When credit markets freeze up and their leveraged competitors are struggling for survival, the cash-rich company can acquire valuable assets or even entire companies at fire sale prices. These are the kinds of deals that can generate massive returns and create shareholder value for decades to come. Buffett's investments in Goldman Sachs and General Electric during the 2008 financial crisis are perfect examples. He was able to demand incredibly favorable terms because he had the cash when no one else did. For an individual investor, holding a portion of your portfolio in cash and avoiding margin debt creates the exact same strategic advantage. A market crash is not a threat, it is the shopping opportunity of a lifetime. The financial connection here is direct. Avoiding debt allows you to buy assets from those who are forced to sell them because of their debt. This is a systematic transfer of wealth from the impatient and over-leveraged to the patient and prudent. On a company's financial statements, this strength is visible everywhere. It's not just the low debt-to-equity ratio. You will also see higher and more stable profit margins, as the company is not burdened by heavy interest expenses. You will see stronger cash flow, as more of the money generated by the business can be reinvested or returned to shareholders, rather than being diverted to creditors. The return on equity, ROE, will be of a higher quality. A company can artificially boost its ROE by using a lot of debt, but this is a fragile, low-quality return. A company that generates a high ROE with little or no debt is a truly superior business. For the entrepreneur or CEO, this translates into survival and long-term value creation. The business that avoids debt maintains control over its own destiny. It is never at the mercy of a banker. This independence allows for true long-term thinking, a focus on building a sustainable business rather than just meeting the next quarterly interest payment. It is the foundation of building a company that will last for generations. Ultimately, the financial consequence of making a debt-averse philosophy a core pillar of your investment strategy is resilience. You are building a portfolio and a financial life that are designed to withstand shocks. You are sacrificing the illusory promise of quick, leveraged gains for the certainty of sustainable, long-term compounding. This is the trade-off that leads to genuine financial security and the peace of mind that comes from knowing that your financial future is not built on a house of cards. We have now explored the foundations of what to buy, a wonderful business, when to buy it at a discount to its value, where to look for it within your circle of competence, and what structural weaknesses to avoid, excessive debt. But the fifth and final pillar is arguably the most important, for it governs the execution of all the others. This pillar is temperament. As Buffett has famously said, investing is not a game where the guy with the 160 IQ beats the guy with the 130 IQ. Once you have ordinary intelligence, what you need is the temperament to control the urges that get other people into trouble in investing. A crash-proof portfolio is not just a collection of assets, it is the output of a rational mind. The ultimate margin of safety is psychological. The foundational anecdote that perfectly captures the power of temperament is Buffett's behavior during the absolute darkest days of the 2008 financial crisis. The fall of 2008 was a period of unprecedented fear and panic. The global financial system was on the brink of collapse. Lehman Brothers had filed for bankruptcy, Merrill Lynch had been forced into a sale, and AIG, the world's largest insurer, had been bailed out by the government. Credit markets were frozen solid. The stock market was in a freefall. The dominant emotion was sheer terror. Investors, from the smallest retail player to the largest institutional funds, were selling everything they could, desperate to convert their assets to cash. It felt like the end of the world. In the midst of this chaos, Warren Buffett did something remarkable. He began to buy. He wasn't making small tentative purchases. He was deploying billions of dollars into the very heart of the storm. On September 23, 2008, he announced a $5 billion investment in Goldman Sachs, one of the most powerful investment banks, which was then facing intense pressure. The terms were extraordinary. Berkshire received preferred stock paying a 10% dividend, an incredible yield at the time, and warrants to buy common stock at a fixed price. A few weeks later, on October 1st, he made a similar $3 billion investment in General Electric, a pillar of American industry that was struggling to refinance its debt. But perhaps his most important action was not an investment, but an article he wrote for the New York Times on October 16, 2008, titled, "Buy American, I Am." In this article, he laid out his thinking with perfect clarity. He acknowledged the fear and the terrible economic news. He stated, "The financial world is a mess, both in the United States and abroad. Its problems have been cascading into the general economy, and the problems there are now feeding back into the financial world. In the near term, unemployment will rise, business activity will falter, and headlines will continue to be scary." He didn't sugarcoat the situation. But then, he delivered the punchline, "So, I've been buying American stocks." He explained that a simple rule dictates his buying. Be fearful when others are greedy, and be greedy only when others are fearful. He pointed out that in the long run, American businesses would continue to create value, and that buying a diversified portfolio of them at the panic-stricken prices of late 2008 was almost certain to be a winning bet over the long term. He was not trying to time the bottom. He wrote, "I can't predict the short-term movements of the stock market. I haven't the faintest idea as to whether stocks will be higher or lower a month or a year from now. What is likely, however, is that the market will move higher, perhaps substantially so, long before either sentiment or the economy turns up. So if you wait for the robins, spring will be over." This was a masterclass in temperament. While the entire world was reacting to the terrifying headlines and the plunging stock prices, Buffett was acting on a set of simple, long-term principles. His emotions were not governing his decisions. His rational framework was. He was able to see the panic not as a threat, but as an extraordinary opportunity. The fear of others was creating the ultimate margin of safety, allowing him to buy great businesses and lend money at terms that would be unthinkable in a normal market. His actions in 2008 were not the result of a complex algorithm or a secret piece of information. They were the result of a lifetime of cultivating the right psychological disposition. He had trained himself to run toward the fire, not away from it. He understood that the greatest returns are earned not in times of comfort and optimism, but in times of maximum pessimism. These investments in Goldman Sachs and GE were phenomenally successful, earning Berkshire billions of dollars. But more importantly, they were a powerful public demonstration of the fifth pillar, that in the final analysis, it is the ability to remain rational when everyone else is losing their mind that separates the successful long-term investor from the crowd. The psychological principle that Buffett so masterfully demonstrated in 2008 is the active overriding of the most primitive and powerful human emotion, fear. Specifically, he was combating the overwhelming force of herd behavior, driven by a neurological process known as emotional contagion. When we are in a group, emotions can spread like a virus. In a market panic, fear is the contagion. Seeing others panic triggers the amygdala, the threat detection center in our brain. This sets off a fight-or-flight response. Our rational prefrontal cortex, responsible for long-term planning and logical analysis, gets short-circuited. We stop thinking and start reacting. The urge to sell when everyone else is selling is not a failure of character. It's a deep-seated survival instinct. In our evolutionary past, if the herd was running, you ran too. You didn't stop to analyze whether the threat was a real lion or just the wind rustling in the grass. Hesitation could mean death. This instinct, so useful on the savannah, is catastrophic in financial markets. The threat in a market crash is a temporary decline in the quoted prices of your assets. The correct response is often to do nothing or even to buy more, but our caveman brain screams, "Sell, run, survive." Buffett's temperament is the result of consciously building a system that insulates his rational brain from this amygdala hijack. He does this in several ways. First, he has a deep-seated belief in his analytical framework. His focus on long-term business value, as opposed to short-term market prices, gives him an anchor in the storm. When the price of Coca-Cola stock drops 30%, he doesn't see a loss. He sees the same great business, which he understands intimately, now available at a more attractive price. The business is his reality, not the stock quote. Second, he practices what psychologists call emotional regulation. He is able to acknowledge the feeling of fear without being controlled by it. His famous aphorism, "Be greedy when others are fearful," is a cognitive mantra, a pre-programmed command that he can execute when he recognizes the signs of widespread panic. It's a way of reframing the situation. Instead of seeing a crisis, his brain is trained to see an opportunity. This is a skill that can be developed through practice and self-awareness. It's the ability to insert a moment of pause between the emotional stimulus, the market crash, and the behavioral response, panic selling. Third, he has an incredibly long time horizon. Most market participants are operating on a timeline of days, weeks, or months. Buffett is thinking in terms of decades. This long-term perspective shrinks the perceived importance of short-term volatility. A massive, terrifying crash in 2008 appears as just a small blip on a 50-year chart of market progress. By extending his time horizon, he is able to emotionally detach from the present moment chaos and focus on the much more predictable, long-term trend of human progress and economic growth. This is the ultimate tool for a CEO, entrepreneur, or any long-term investor. The ability to make decisions based on a 10-year outlook rather than the next quarter's results is a massive strategic advantage. The temperament required for this kind of investing is not about being emotionless. It's about preventing your emotions from making your financial decisions. It is the deliberate cultivation of patience, discipline, and courage. The courage to be different from the crowd, to act on your analysis even when it feels uncomfortable, and to trust your long-term framework over your short-term fears. This psychological fortitude is the final and most crucial margin of safety. How can an individual investor cultivate this essential temperament? It's not something you're born with. It's a skill you build through conscious practice and the creation of smart systems. This is the blueprint for engineering a rational investment disposition. Step 1 is to create an investment policy statement, IPS. This is a written document that defines your investment goals, your time horizon, your risk tolerance, and the core principles of your strategy. You should write this document during a time of calm and market stability. In it, you should explicitly state how you will behave during a market downturn. For example, you might write, "During a market decline of 20% or more, I will not sell any of my core holdings. Instead, I will review my watch list of high-quality companies and deploy a predetermined amount of my cash reserves to purchase them at their now lower prices." This document acts as your constitution. When a crisis hits and your emotions are running high, you don't have to think. You just have to follow the rules you made for yourself when you were thinking rationally. It is your Ulysses contract. Step 2 is to automate your investment process as much as possible. The best way to take emotion out of the decision is to remove the decision itself. Set up an automatic investment plan that regularly transfers a fixed amount of money from your bank account into your chosen low-cost index fund or portfolio of stocks. This is called dollar-cost averaging. By investing the same amount of money every month or every quarter, you automatically buy more shares when prices are low and fewer shares when prices are high. This removes the temptation to try to time the market and forces you to be a buyer during downturns, which is the key to long-term success. Automation is the single most effective tool for enforcing discipline. Step 3 is to control your information intake. During a market panic, the financial media becomes a fire hose of fear-mongering and sensationalism. Watching the market tick by tick and consuming this constant stream of negative news is guaranteed to trigger your fight-or-flight response. The best thing you can do for your financial health during a crash is to turn it off. Limit yourself to checking your portfolio once a quarter. Stop watching financial news. Get your information from primary sources, like company annual reports, rather than from commentators whose job is to generate clicks and ratings. Curation of your information environment is a critical part of emotional regulation. Step 4 is to study market history. Read about the great crashes of the past, 1929, 1987, 2000, 2008. When you realize that devastating downturns are a regular and recurring feature of the market, they become less terrifying. You will see that every single crash in history has been followed by an eventual recovery and new all-time highs. This historical perspective provides the context and confidence needed to ride out the storm. It helps you to see the current crisis not as an unprecedented catastrophe, but as another chapter in a long, predictable story. This knowledge is the antidote to the "this time is different" fallacy. Step 5 is to have a fat pitch watch list. This is a pre-researched list of 5 to 10 wonderful companies that you would love to own but whose current stock prices are too high. For each company, you should calculate a buy price, the price at which you believe it would offer a significant margin of safety. When a market crash happens, you don't have to panic or wonder what to do. You simply consult your list. Has company X on your list fallen to your predetermined buy price? If so, you act. This turns a moment of fear into a simple, mechanical execution of a pre-planned strategy. This blueprint is about building a system that protects you from yourself. It acknowledges that we are all emotional, irrational creatures, and it puts guardrails in place to keep those tendencies from derailing our long-term financial goals. By developing these habits and systems, you can cultivate the temperament of a master investor, enabling you to navigate market volatility with confidence and achieve true, lasting financial security. The antithesis of a stable, rational temperament is the path of the 99%, the path of the reactive, emotional gambler. This investor has no written plan, no long-term philosophy, and no control over their emotional responses to market events. Their financial decisions are driven entirely by the twin emotions of greed and fear. In a bull market, this investor is a genius. They are fully invested, often on margin. They check their portfolio multiple times a day, reveling in the rising numbers. They are constantly talking about their winners and chasing the hottest stocks. Their greed is palpable. They see the market as an easy money machine, and they feel invincible. Their overconfidence leads them to take on more and more risk, convinced that the party will never end. They are the person who quits their job to become a day trader after a few months of a rising market. They are completely unprepared, psychologically and financially, for a downturn. When the market inevitably turns, this investor's world collapses. The first 10% drop is dismissed as a healthy correction, a buying opportunity. But as the decline continues to 20% or 30%, fear begins to take hold. The daily portfolio checks, which were once a source of pleasure, become a source of intense pain. The financial news, which once seemed so optimistic, is now filled with predictions of doom. The investor's confidence evaporates, replaced by a gnawing anxiety. They have no anchor, no valuation framework to hold on to. Their only reality is the sea of red on their screen. As the panic intensifies, the herd behavior kicks in. They hear stories of friends losing their savings. They read headlines about an impending depression. Their amygdala is in full control. The primal urge to stop the pain becomes overwhelming. Finally, usually after the market has already fallen 40% or 50%, they capitulate. They sell everything, vowing never to invest in the stock market again. They lock in their catastrophic losses at the point of maximum pessimism. The financial consequence of this behavior is devastating. They have perfectly executed the strategy of buying high and selling low. They have not only lost a huge portion of their capital, but they have also emotionally scarred themselves, ensuring they will miss the subsequent recovery. The market eventually bottoms and begins its long climb back. But the reactive investor is on the sidelines. They are too scared to get back in. They wait for things to feel safe again. They wait for the economy to recover and the headlines to turn positive. By the time they finally feel comfortable enough to reinvest, the market has already recovered most of its losses. They end up buying back in at prices much higher than where they sold. They have perfectly missed the best buying opportunity in a generation. This cycle of greed and fear is the single greatest destroyer of wealth for the average person. It is a direct result of a lack of temperament, a failure to have a plan, and an inability to control one's emotional reactions to external events. It is a guaranteed path to financial mediocrity or worse. The disciplined, patient, and rational temperament is not just a nice-to-have in investing. It is the entire game. Without it, no amount of intelligence or analytical skill will save you. The direct financial connection between cultivating the right temperament and your long-term wealth is the most critical link in the entire investment process. It is the master variable that determines whether your brilliant analysis actually translates into real-world profits. A rational temperament is the mechanism that allows you to harvest the rewards offered by the other four pillars. First, temperament is what enables you to actually capture the benefits of the margin of safety. You can do all the analytical work in the world to determine that a stock is worth $100 and is trading for $50. But this discount, this margin of safety, is only valuable if you have the emotional fortitude to buy the stock when it is unloved and feared, and the patience to hold it until the market recognizes its value. Without the right temperament, you will be too scared to buy when the price is low, and you will become too impatient to hold on for the recovery. Temperament is what turns a theoretical margin of safety on a spreadsheet into actual cash in your brokerage account. Second, a stable temperament allows you to profit from market volatility instead of being a victim of it. For the reactive investor, volatility is a source of pain and loss. For the rational investor, volatility is a source of opportunity. A market crash is a gift, a chance to redeploy capital from fully valued assets into undervalued ones. The financial result of this is a dividend. Over time, the investor who systematically rebalances their portfolio, selling some winners and buying assets that have been beaten down, will earn a higher return than one who simply buys and holds, and a vastly higher return than one who panics and sells. This excess return is a direct payment for providing liquidity and rationality to the market when it is in short supply. It is a financial reward for your good behavior. Third, temperament has a direct and massive impact on your lifetime compounding rate. As we saw, the person who panics and sells during a crash not only locks in a loss, but also misses the powerful recovery that follows. This act of pulling your capital out of the market for even a few of the best recovery days or weeks can have a devastating impact on your long-term returns. Studies have shown that missing just the 10 best days in the market over a period of several decades can cut your total return in half. A calm temperament ensures that your capital stays invested, continually working and compounding for you through all market cycles. This uninterrupted compounding is the key to building substantial wealth. For an entrepreneur or CEO, this connection is equally stark. The leader with a calm, long-term temperament can steer their company through a recession without making panic decisions like firing key employees or slashing crucial R&D projects. This allows the company to emerge from the downturn stronger and more competitive. Their emotional stability becomes a tangible strategic asset, directly impacting the company's financial performance and long-term viability. In the end, all 5 pillars converge on this point. Your ability to value a business, identify a moat, stay within your circle of competence, and avoid debt are all analytical skills. But it is your temperament that determines whether you can execute on that analysis when it matters most, in the crucible of a market crisis. It is the bridge between knowing what to do and actually doing it, and that bridge is where the journey to financial freedom is either won or lost. You have just navigated the 5 foundational pillars of a truly crash-proof portfolio. You have ingested a complete mental framework, a system of thought that has been stress-tested over a century of market chaos and has emerged not just intact, but victorious. You now possess the blueprint that underpins one of the greatest financial fortunes ever built. You understand that before you ever think about the intoxicating potential of what could go right, you must first build an unbreachable defense against what could go wrong. You have learned to demand a margin of safety in valuation, to insist on the resilience of a business moat, to respect the boundaries of your own circle of competence, to fear the fragility of debt, and to cultivate the unflappable temperament of a master. This is no longer just abstract theory. It is a powerful set of mental tools you now have at your disposal, a new lens through which you can view every financial decision, protecting you from the costly mistakes that plague the 99%, and positioning you to act with clarity and confidence when opportunity arises from turmoil. But mastering these 5 pillars, as critical as they are, is like learning the individual movements of a grandmaster in chess. You may understand the power of the rook and the strategy of controlling the center, but understanding the pieces is not the same as seeing the whole board. Warren Buffett's system is not just a checklist of 5 independent ideas, it is a dynamic, interconnected network of mental models. The true genius lies not just in applying each pillar, but in knowing how they interact, how they balance each other, and, most importantly, when a weakness in one pillar can be compensated for by an overwhelming strength in another. The video that is now on your screen is the next piece of this map. It is the vital link that connects these individual pillars into a cohesive, operational strategy. It moves beyond the what and delves into the how and the when. It explores the intricate dance between price and quality, the moments when a deep discount can justify a weaker moat, or when an unbreachable moat can justify paying a fuller price. It addresses the real-world complexities and trade-offs that every serious investor must navigate. The decision you are about to make is not about watching another video. It is a declaration of your intent. Are you content to be a collector of interesting ideas? Or are you committed to becoming a practitioner of a proven philosophy? The amateur learns a rule. The professional learns the exceptions. The person on the path to financial security understands that the journey is one of continuous learning, of adding layers to their understanding, until their mental arsenal is complete. The next piece of that arsenal is waiting for you. It holds the key to synthesizing what you have just learned into a fluid, adaptable strategy. The choice is yours. Complete your map. Click and continue your ascent.